Guys, welcome back to the Capital Mindset Show. We are your hosts, Austin and Fabio, and today we're going to be talking about Micron and Intel. What kind of a face was that? What kind of a face was that?
It's a snack eating face.
It's a snack eating face.
Yeah.
Well,
I do it every time I eat a snack. Trust me.
What snack are you eating? Are those peanuts?
No.
No. Cheerios? You're just eating a
snack.
bowl of Cheerios?
Yeah.
With no milk or anything? You're just eating it out of the bowl like an uncivilized person?
I didn't say there wasn't milk.
Oh,
No kidding.
Well, with that being said, that wraps up the show. No. Anyways, we're going to be talking about Micron and Intel today. We're going to be kind of exploring these two stocks as well as plugging them into our DCF analysis, exploring the industry that these stocks are in. And then also we're going to be giving our final thoughts at the very end. So without further ado, what are we looking at here today?
So dramatic. All right. So
yeah, but like how I was thinking about saying it in Spanish, but then I was like, no, I'm not doing that.
Español. Mira. All right. So which one do you want to do first? The guns
Micron
to your head.
Technologies.
Micron. All right. We're going to do Intel because you said that. I'm kidding.
So
I'm kidding.
am I
we'll do
dead
Micron
now? All right, cool. Still alive for this time.
All right. So we're too small. Let me become bigger, larger. So Micron Technologies. This one is a fan favorite of, well, not fan favorite, but it is a favorite of some people because certain super investors, as they're called, are invested in this entity. And basically Micron, do you know what they do? Awesome. Before I go into that.
It's a semiconductor company, correct?
Specifically, what kind?
Is it a fabless semiconductor company?
That's not the part where I'm going with. It's the products they make.
Okay. So I would not assume they probably aren't making CPUs and the rest of that kind of stuff. Are they making chipsets that go into Intel or AMD products? Then what are they making?
RAM, memory.
Ah, okay.
Yep. So they're very important for the server market, right? So as the world becomes more data dependent, they are going to be or have been experiencing tremendous amounts of tailwinds. So Micron has come out on top in some regards, in a lot of regards, and there's only a couple players. So essentially, it's actually run by kind of an oligopoly. The players that I'm familiar with is Micron, Samsung, and Western Digital, I believe. So those are the three key players that are coming up from the top of my mind. And this is a very capital intensive business. I know that Micron actually just started paying a dividend. It's actually fairly recent. They've never paid a dividend until now. And on the surface, they're going to look cheap. So there's a lot of key metrics a lot of people use for Micron. One of them is book value per share. So there's been times that Micron's traded below book value, and something like Micron, it's actually ideal if you can acquire it for below book value. But some might say also, and it's a fair argument, let me be assertive on that, that right now Micron doesn't deserve to trade below book value, and that's something of the past, because again, we can't extrapolate too much from the past. We have to look towards the future, and Micron might now be a different type of company, and the industry might have evolved in a certain way that now it can demand a heftier premium than it once did. So that's for us to kind of determine as we do more research, but that's kind of giving you the overview. Let's take a look at the 5-year price movement of Micron, and it's actually done quite well. So if we actually take a look at from the first and to the last, it's done about 353%. And you can see that up here, but I wanted to drag it.
You just wanted to do it for the added flair. I get it.
The added little. And then since IPO, it's about 6,000%. So not too bad. There has been better in that time frame, but not too bad. You can see here that you want to be careful with this. It can be quite cyclical. However, this is more of like the dot-com bubble. It's not actually due with the business performance, because if you look back then, there actually wasn't a tremendous amount of fundamentals backing up that price tag, and you had to be quite brave, if we're being honest, investing here. So that would have taken a tremendous amount of knowledge about the business, and you're buying it here. When you see this, if this is your past, you can imagine how skeptical people would be. But going forward, right, it looks like they have a bright future ahead of them. And more recently, we can see this price action. They jumped from the $60 all the way around to $85, which is about a 27% rise. And from here, I think it's fair to say we can jump right into the model, right? Would you agree?
Yeah. Oh yeah. Let us do it.
Any specific industry questions right now you have, Austin, or you think you have?
Yeah, I'm kind of curious as to what maybe some potential industry headwinds and tailwinds are currently facing Micron specifically. Maybe not, or it may or may not even apply to Intel, but definitely Micron specifically.
Yes, because in this video we're going to be covering both, but the world is going to become more and more digitized. With that comes more and more a greater necessity for memory storage. And Micron provides exactly that. So if you think the world's going to continue to need more and more memory storage capacity, then Micron and Samsung and all these other businesses are going to stand to benefit. Except Micron, I think Western Digital are heavily focused. Samsung does a bunch of other things. Like I assume some of our audience may have Samsung phones. So if we can see here, let's take a look at what analysts think. So the 52-week low, it's actually closer to the 52-week high. And then analysts right now rate it as a buy with a price target of about $99.22, implying a 16.5% upside. We see some interesting volume, okay, but nothing too crazy actually, because if you multiply this time this, it's not going to be a great amount of the market cap, because the market cap right here is 95 billion, enterprise value of 92 billion. What does that mean, Austin?
That's the market cap when you take out the cash and then you just include basically the debt. So the smell test is if enterprise value is more than the market cap. That might,
we like that.
There might be some issues with debt. I do.
Yeah, we like that. So we like when the enterprise value is less than the market cap. When it's greater, it's not necessarily something we hate or we won't invest in because of that, but we like to see that there is a greater substance in terms of cash and debt. Okay, so what discount rate do you think is appropriate? I think actually, no, let's start with the 10% standard, right? Standard market rate of return. And let's see, have they been doing buybacks? They have. Very cute little buyback. So I think it's safe to assume that we can assume that going forward. And now the average growth rate has been 10% over the past 5 years. So actually, let me actually go down to the recovery calculator, because I can actually use this and tell myself, okay, what about if I take 4? Okay, what about if I take 5? Okay, so let's be as aggressive as possible. Let's say 4%. Not 4%, sorry, 4 years.
Yeah.
Okay. Well, let's see 1. Okay, 1 was a crazy year back then. All right. Not 8, sorry. 4, and then we said 5. Yeah, let's do 4. Let's take the 8%. So let's assume an 8% growth rate. And then let's assume let's go a little higher, 15. And then let's actually assume here, we'll put the 15 here. Let's assume a 20, so like an out there. Let's assume then around 5 and 1%. And let's actually,
oh boy, wow.
Well, we have to actually customize our weightings. So I would say between these two, we can, I think these are less probable. I think together they should be about 10%. So let's do 2% there, 8% there. This I think is too high. I'd actually align this more to 30. And then this one more to, because I think 15% going forward is potentially more likely. I think actually it's going to lean more in this area. So I'd put this at 15 and then 45. Okay, so basically assuming this, these assumptions, I shouldn't be adding Micron at these levels on a 10-year model. Okay, and I'm assuming a buyback of 0.89%, and I'm trying to get a required rate of return of 10%. Now, what might be going on here is my growth rates down here might be a little too conservative. So if we shift everything a little bit up, so let's say the lowest is 5%, then this becomes 8%, and then 8% actually changes over to 12%. I lean more heavily on this part. And then 15, let's say it goes to 17, and 20 goes to 25%. You can see here now it's kind of changing. It's looking a little brighter. So with Micron, you want to hopefully expect greater growth in the range of 17 to 25%. Otherwise, it's overvalued based on the cash flows. Now, let me take a look real quick here. So actually, there's some details that we're gonna come back to this, and let's go to the key ratios. And what I want to pay attention to is the and this is where I should explain to everyone how I spotted this. So you look at the PE. The PE is 16.28. Looks cheap on the PE basis. Price to free cash flow, 23. Okay. So remember in another video, I talked about the importance of knowing when to use GAAP and when not to use GAAP. Okay. This may be a moment when you want to use GAAP. So let's think about this logically from the perspective of Micron. Micron does what? They sell memory chips. Who do they sell memory chips to?
Typically manufacturers, maybe some end consumers as well.
Okay, perhaps some end consumers, but like mainly like, the PC manufacturers.
Yeah.
Like Dell, for example, you buy a laptop, there's some Micron memory in there, servers, etc. So the point is they're these end customers. And when Micron sells it to them, when do they recognize the revenue?
When the performance obligation is satisfied.
Basically, exactly. No, but when is the performance obligation satisfied?
I would probably say when those components that Micron produces are actually given to the manufacturers themselves.
Good. So the agreement details may be that the cash and the actual performance obligation, there may either be a lag or an acceleration. So the accrual basis of accounting may seem low, but the cash flows, right? On a cash flow basis, the price looks high. That could be because the performance obligations are allowing them to recognize the stuff that was paid for last year, because we know that there are supply chain problems, right? So, but going forward, is that going to change? And that's going to flip the cash flow number, because right now, if they're not getting cash, right, from their components, that's going to be reflected this year. And that actually might be why we saw the price movement spike up, because remember, prices are forward looking, right? They tend to be forward looking. So this might be pricing in the fact that that's going to change. And that's kind of, again, an investor has to draw the story from the numbers, right? The numbers are telling me a story, and it's up to me to decipher their message, and then from that make conclusions about perhaps what the future may have in store. So that's a little tidbit as to the difference between GAAP accounting and cash flow accounting, something that a lot of channels don't really go into. They either just look at them and they don't really explain too much about the difference. And then there's the added nuance besides just knowing, oh, one excludes depreciation, amortization. There's also the nuance of when an industry requires you to look at GAAP versus paying more attention to cash flows at any given point. Right? Because then there's the added nuance that it could be the timing, right? Depending on what part of the year you're looking at, depending on what happened within a year, depending on what part of the cycle you're in, because Micron is part of a cyclical industry. Memory goes up in price, down in price, up in price, down in price. They're trying to mitigate that, but still, that being said, there is a buy cycle for servers, et cetera, PC upgrades, et cetera. So we need to put that in the back of our minds. There's that book value per share at $39. If you could get Micron at below 39, that was the trade how you used to be able to invest in Micron in the past. There were a lot of moments where you could have bought Micron for lower than book value. And I actually did invest in Micron when it was below book value. I don't currently hold Micron, before anyone thinks that. I don't hold Micron currently, but I have owned Micron in the past. I did okay on it. Okay. So that's just some tidbits that I'm sharing with you guys about some of the understanding you need to invest in a company like this. So right here, it's a lot of these numbers, and I'll go through them bit by bit, are confirming my theory, okay, about the cash. So a lot of times the earnings per share is greater than the cash flow per share, free cash flow per share. This tends to be a negative thing, right? Now, that could be because they're not receiving the cash, or not that could be, that most likely is because they're not receiving the cash immediately, okay? They're not receiving it immediately, or they're receiving it before. And we would need to find that out. How are they recognize the revenue versus when are they receiving the cash? And we can get a hint from that in the cash conversion cycle, but we'll get to that in a second. Let's actually go back to liquidity ratios because we'll do this in order. So liquidity ratios look fantastic, for being honest. They look great. Then total debt ratio, all of this is really good. Pristine balance sheet. And then gross profit margin, well, this is the negative. It's been declining, but however, it's been rising since 2019. So that's a positive. But I would love to see 2017 levels come back. And then everything else kind of also been deteriorating. 2017 seems to be like a peak year for that cyclical part of the industry. Earnings quality seems to be fantastic. So I like to see that. Now, again, we're returning to that cash flow. So let's go look at our activity ratios, and that can help us decipher whether or not which theory is true. So the cash conversion cycle, it's basically telling me that they're getting the cash far later. All right. So this is telling me that these income numbers are actually what? They delayed?
Yeah, well, I was about to ask precisely that. Isn't that just inherent by the very nature of their business itself, that they're always going to receive cash at a later point?
Yes.
So the
Precisely.
added nuance is that all of these ratios will always be sort of higher when they should be lower, lower when they should be higher.
Precisely. Exactly. Yeah. So we have to actually look forward. So the earnings now are reflective of cash flows received in the future. Exactly that. That's what that means. So it confirms the theory. Again, deriving a story from the numbers, not simply looking at past numbers and then saying beep boop, stock go up, beep boop by ratio. Remember that video where we were a little bit what was that word that I use where people rely on ratios? Just say it. We're not even monetized. Say it.
Yeah, ratio whore.
Hey, yeah, you dirty ratio whore.
This man.
All right, we're not monetized right now. We can say whatever we want. Once we're monetized, we have to censor ourselves. All right, yeah. So it's like no.
This man.
All right, so yeah, so basically what we're looking at here is that the earnings per share are reflective of cash flows that they're going to receive into the future. Give or take a little bit, but it'll average out about the same over time. It's just you got to be aware of the delay. Okay, so that's basically what I'm saying. On the cash flow basis, it looks expensive, but in this case, it may be more appropriate to apply the actual PE to it. And you won't hear me say that too often. So what this means is the cash flows perhaps are going to grow tremendously. So now, remember what it's at. It's about double, right? There's going to be about a doubling at some point in the future from the cash flows, right? And what are we discounting?
Cash flows.
So yes, the growth rate has to be greater than what we're doing, right? You see how we went through this journey, right? So we made initial assumptions, little tidbits here and there, and then now we're coming back full circle, and we're going to make some assumptions. So I think now it kind of makes sense. The investment that companies are going to be doing into memory going forward is going to be tremendous. So we can say, for example, I think on the low end they might grow at 10. And then we say 15, and then from here we can add a 17, and then we put our 25, and then we say our high range of 30. All right. Now, ready for some destruction? So now things are starting to make more sense because it looks super pessimistic. We were only discounting at 10%. All right, this is the destruction. Boom. All right, as soon as you discount it for a margin of safety, annihilation, because this kind of makes sense. What you're demanding from it is about a 50% margin of safety. So it's telling you that you should be buying, if it ever pulls back, if we get a big pullback and you get it below around in this range of $45, you'd be getting it close to the book value, and you'd be getting at a decent margin of safety where you can be kind of wrong and still come out on top. So this is after we made our adjustments for the cash flow growth, because even despite that, the cash flow growth has been about 10% over the past 5 years. When we take into account that the cash flows are showing us a different kind of picture from the GAAP EPS, and we make that adjustment, and we come to an understanding that the growth is actually probably accelerated, right? Then even despite that, we see that it's not favorable right now, right? But it can be in the future, all right? We may get an opportune moment. And if we discount it at 20% for those who want to take a look, if you could somehow get this at $29 a share, that would be in the median range. And you would actually stand to, in my opinion, have a very good risk reward, right? Right now, the models tell me don't even like think about adding anything to this. But what it's going to be doing is if the price comes down, it's actually automatically going to change as long as I keep these exact assumptions in place. Okay. So last closing thoughts on Micron before I move on to Intel.
I definitely think it's an interesting business. Just me personally, when it comes to semiconductors, I would rather own the companies that produce CPUs and some cases GPUs. And that's just me personally. That's just my own opinion here. But what about you? What do you think?
I mean, I'll buy any business if you give it to me at the right price. At the right price, and the better the business, the more premium I'm willing to pay, or I'm allowing to like let go. But for Micron, I think it's an interesting company, and it's a good play on the memory part of the future of information. But I'm not willing to pay current prices. Of course, I could be completely stupid and you just follow the analyst, and the analysts say buy, and they give it a $99 price target. Now, they may be doing that based on momentum or whatever other metrics that they're using. But that being said, I'm not willing to play that game. I'm willing to invest when there's a decent margin of safety. When this company is kind of thrown into the dirt and no one wants it, then I'll be interested. All right. On that note, we'll skip over to Intel. So Austin, do you have a position in Intel?
I do. I have a small position in Intel.
So do I.
I think the
small
company
position.
is it's pretty interesting, and I do like their product offerings, and kind of also just sort of touching on what you just said, where the company's down in the dirt and nobody wants it. And I kind of believe that story is true for Intel here right now. It has been performing pretty terribly in my portfolio, but I'm willing to kind of shoulder that entire performance because I do believe in the future of where the company could go. So
yeah, and we'll actually take a look at it. So I also have a small position in my portfolio, and we'll actually take a look at what the model says that should be like the goalpost of position sizing for Intel. So I'll allow you, Austin. First, let's actually take a look at what the analysts say. So the analysts say you're facing a 12.9% upside from here, and they say it's a hold. All right, so they're not telling you to buy or sell it. So let's discount it against standard 10%. Do you have any growth rates that you have in mind?
I'm probably going to go with 15% for the first one.
Oh, wow.
Yeah. So this is more so just kind of just kind of throwing these out. And then 5%.
Okay, no. I like to do it in order. Is this your lowest?
Yes.
Okay.
And then 15% is my highest.
Oh, okay. Okay, now that makes sense. 15%.
Yeah, and then everything just in between that.
Okay, so we can do 10. The reason I'm doing 10 is it's already a buy at 5, so let's not go crazy. So I'm gonna change your answer. I'm gonna put 5 here. I'm gonna put 1 there. Okay, so according to the model, you see as a standardized goalpost, and let's actually even this out. Oh, sorry, not even. I wanted it like that. I wanted that. No. Basically, it's saying you can take on leverage about 300 times, or 300%. Sorry, not 300 times. 3 times leverage on your portfolio, and you can achieve your 10% rate of return. Basically, it's saying yes, do it. In other words, don't take on leverage, right? It's not. You shouldn't be doing that. But it's basically saying yes 10 times over if these things occur. And these are and you're weighting these scenarios evenly. It's in your favor. The risk reward is in your favor, and you should definitely be buying. However, if your expectations are slightly higher, and by the way, we're not even assuming buybacks. Let's actually get in these buybacks, and let's assume 1%. All right. So you see now it's saying like there's no risk involved according to these assumptions, right? Because you're only telling the model these are the 5 assumptions that will happen, right? Between this. So if it happens between that, it's saying, there's no risk, buy. But that's not how life works. So we need to assume certain things will occur, and we do that through discounting it further. So we discount at 15%.
Increasing our margin of safety there in that
precisely.
instance.
Remember, we're increasing our margin of safety by 50%, right?
Yeah.
Over the market average. So I remind everyone, as the price lowers, this goalpost will start to increase, assuming everything remains the same. The fundamentals remain the same, and your assumptions remain the same. So if, and again, I can actually increase not increase, but change the weightings. And now if you think, for example, it's more probable, and we can change these percentages at your will, Austin, you just decide and I'll do it for you. We can change the weightings of these percentages. If you think one's like very probable more than another, you can see that it went up when I did that, because I'm basically weighting these 2 scenarios lower, right? And together they add up to 17%. And I'm basically saying a 7% growth rate is the most probable. I'm assuming a lower buyback than average. So this is where I'm being conservative, but I am assuming a buyback. And we are assuming a slightly higher growth rate, but maybe that's appropriate, because as smart cities expand and all these new addressable markets come to fruition for Intel, you may experience that benefit. We also have a dividend. Are you going to be reinvesting your dividend?
Yes.
Okay, so then I can fairly say that that's going to be about a 4%. Okay.
Yeah.
Now, how? Because you're going to be reinvesting, and so you get the buyback and you reinvest the dividends. So your ownership is growing by that amount, right? So let's assume that we want a greater margin of safety. Now we're back down. You see that now went to 0.82%, right? Because you now increase the margin of safety by about 100% the standard, right? So it makes sense, right? So let's go to like a 17%. And so you see 17% perhaps reasonable, but what are you expecting? Like, what is your desired rate of return, Austin?
Well, I mean, typically I just put in a 10% and then I just throw on a added margin of safety. So I think I actually discounted this at like about 17%. I think that was the actual number I used when I first.
So as a goalpost measure,
analysis.
if these are the assumptions you're making, remember we have a 1% scenario, right? Maybe we want to, let's add more weighting to that to be a little safer. And let's take away from this one. Let's put that at 25. So you see the model is kind of giving you a goalpost of about 4.5% of your portfolio should be allocated to Intel. That's a goalpost. For everyone watching, goalpost, not a definitive amount. It's kind of like to give you an idea of, based on the risk reward profile, based on the assumptions made, what it should be, right?
Okay.
So
yeah,
looking fair. All right. So let's go look at the key ratios, because so we can finish off Intel. So earnings quality for both companies came out very good. Anything above 1, by the way, is how you would read this. This is a unique measure I like to use. And we see a nice free cash flow margin. We see that the EPS tends to be higher than the free cash flow per share, right? So again, probably the same reason as Micron. And go down here. Yes, it's the same reason. So let's see here. This is getting worse. Okay, so these are things that you want to be careful about. So gross profit margin has been going down. That's indicative of competition. Remember, derive a story from the numbers. Don't just look at the numbers and say, oh, gross margin is blah, blah, blah. No, what does it mean? So gross margins going down tend to mean that they're struggling to sell the products at the same premium as before, where costs are going up. And costs can go up in a variety of ways. So inflation, for example, if inflation rises and you're not able to pass on the cost to consumer, your gross profits are going to be coming down, right? So that's, you see, you'd see that in the gross profit margin. So if you're looking at a food company and you see that, then that would be a flag for you to pay attention to. All right, so that's pretty much it for what I'd see here. Activity ratios. nothing's really highlighting as like a red flag. So I think that's fine. If you guys ever want to pause, you can pause here. I'll go a little slower and you can just pause and look at it for yourself. All right. On that note, going back to the summary. So what do you think, Austin? You're going to be adding to your Intel position? What current percentage?
There's it's a small percentage. I'd say it's probably about like 1-2% of my portfolio. I'm gonna potentially add more into Intel, but there's some other things that I need to check. I need to sort of see more initiative by management that they're willing to, try to beat or try to at least take back market share from AMD in this instance before I increase my position in Intel. But that's just me personally. So,
well, I mean, how big is the market?
I don't know. I'm not really too sure how big it is. Do you know how big it is? I know it's big. So
it's going to be in the several hundreds of billions of dollars. So like about $200-300 billion, but it's going to be growing rapidly, about 15-20% per year. Wow. The TAM of Intel is growing a lot because they're getting into self-driving cars, et cetera. So they have chips going into their whatever customers may be using in the future, because the technology isn't really being utilized as of now. Mobileye is their division. And then I know they have a graphics cards coming out. I think one of them is already out, but it's like for the mobile, it's a mobile graphics card. But let's see if they ever start to compete in the actual graphics card market, kind of like NVIDIA's. We haven't even gone over NVIDIA or AMD, but we can make videos about those too. AMD has actually gone up quite nicely, while Intel's kind of just lagged. And you're right, Intel, like you said, for Micron, Intel's kind of left for dead. I think Intel and AMD are very close to the same market cap, which is really interesting.
Yeah,
if you ask me.
Very interesting.
So I'd imagine we can probably do a video on AMD, and leave a comment down below if you guys want us to see us do a video on AMD, and we'll do a video on NVIDIA. So yeah, just let us know. So this is kind of like the way we were looking at it, and I'd be adding Intel actually at these levels. So what I'm interested in is if I can get it at that 5. I want to be a little more conservative than this. If I'm being honest, I actually would liked it at the 1%. So here, if I could get it at like $40 per share and below, I'd be buying this thing a lot. Yeah. So it'd be becoming a big position in my portfolio. And you see under these assumptions, it's telling me do not add Intel to the portfolio based on the risk profile, and be very careful what that means. So like, it doesn't mean that it's a certainty that something will happen. It's assuming based on the current assumptions and the weightings you were putting on each scenario that you may get a better opportunity to buy. That's what the model is telling you. So that's why it means negative, or it could mean, or you could interpret it as short it, for the short term, and then it will change its assumptions as the price continues to go down. And if it continues to go up, also it changes assumptions. So it would become more negative as the price goes up, more positive as the price goes down. So like, for example, if the price was like 30 right now, then this would be telling you, oh no, it'd be like, very high, like 15%, something like that, or maybe even 20%. But yeah, that's pretty much how I'm thinking about it. So I'll be nibbling. It's right now, I think, sitting at point. Was it like, yeah, I think it's like a 0.7% of my portfolio, something around there. Yeah. It's around 0.7% of my portfolio. So it's not too small by any stretch of the imagination. For some people, it's a big position, but for the portfolio size, it's not that much. So I think on that note, we're all set.
Yeah. Well, with that being said, you've heard it here, folks. We are your hosts, Austin and Fabio. This is the Capital Mindset Show. If you enjoyed what you've seen here today, please be sure to share the video. It really helps out the channel. Please be sure to visit our website at capitalmindset.org and like, comment, and subscribe. And we'll see you guys later.